Hello and welcome. You tune into Rush Hour with me, Ankita Saxena. Well, the ECB has cut interest rates for the second time in 3 months. The central bank brought down its key interest deposit rates by 25 basis points to 3.5% and also reduced its main refinancing rate by 60 basis points to 3.65%. President Christine Lagarde said that the labour market remains resilient and also added that the demand for labour is expected to moderate further. Listen to an excerpt from Christine Lagarde and what she had to say.
Domestic inflation remains high as wages are still rising at an elevated pace. However, labour cost pressures are moderating and profits are partially buffering the impact of higher wages on inflation. Financing conditions remain restrictive and economic activity is still subdued, reflecting weak private consumption and investment. Staff project that the economy will grow by 0.8% in 24, rising to 1.3% in 25 and 1.5% in 26.
And well, to weigh in on the situation, Geoffrey Dennis, independent emerging markets commentator, is joining us. Hi, Mr. Dennis. Thank you so much for joining us on Russia.
Good morning.
Mr. Dennis, straight off the bat, the ECB has delivered a quarter-point interest rate cut, marking its second reduction in the deposit rate this year. Now, the widely anticipated move comes after a period of sluggish economic growth across Eurozone, and the cooling inflation. Now, while this was already in line with expectations, the rate cut, the ECB has also lowered its 2024 growth forecast to 0.8%, down slightly from the earlier projection of 0.9%. They're citing weaker contribution from domestic demand over the next few quarters. Now, if you look at it, recessionary fears and demand fears are back on the table for Europe and for the US. Is there any chance that there could be a demand reversal anytime soon?
Yes, there could be a demand reversal. I think it's probably unlikely in Europe. Frankly, European growth is weaker than the US, but I don't think these are recessionary signals at this point. These are very, very minor cuts in forecast for 24 and 25 by the ECB. And although growth is low and although US growth has slowed down, I don't see a recession, frankly, in either of these two sets of economies. And I think, therefore, the ECB was right to cut by 25 basis points only today. And for Christine Lagarde to say that she would be data dependent and would go meeting to meeting, as opposed to giving the market any real outlook for the next several meetings at this point today.
Right. Also, Mr. Dennis, economists are split over whether the policymakers at the ECB will look to pause when they meet again on October 17th, as they had done in the July month, before potentially really reducing rates by another quarter point, on December 12th. Now, the big question is not whether the ECB would cut rates in September, but what is the central bank's stance on what is likely to follow? Your thoughts on that?
Well, I think the first thing to bear in mind here is real interest rates in Europe, in the EU, I should say, are lower than they are in the US by over 100 basis points. And so in theory, there is less room for the ECB to reduce rates to get to some sort of neutral level. That is the case with the Federal Reserve. And this is exactly why I understand that the first reaction, the FX market today, to the ECB decision is actually to push the euro slightly higher. I think there is much more scope for interest rates to come down more significantly in the US over the next 12 months than in Europe, or perhaps I should say than in the EU, the euro area. And therefore, I would not be surprised if they paused. It's very hard to make a call at this point because it will depend also on the macroeconomic data. But my guiding principle here is that interest rates in the euro area have got less distance to fall than they do in the US. That will push the dollar lower. And that, I think, means a rate cut in October is, as you say, far from certain, although I'm sure we'll get one more rate cut before the end of the year.
All right, Mr. Dennis, one question on the Fed meeting outcome also next week. We are expecting Fed to cut rates by a quarter percentage point next week. Are there any chances of an outsized rate cut given the demand and the weak economic concerns?
Yes, there is a chance of an outsized rate hike of 50 basis points, but I think that chance has been significantly reduced, possibly to 1 in 5, by the some of the details, of course, of the CPI data earlier in the week. So, for example, the 0.3% increase in core is above consensus, albeit it's not very different from 0.2, but I think there is still concern about shelter in the headline index and also in the core and the core level itself, although of course the headline rate came down sharply to 2.5%. I don't think there's enough here in terms of inflation softening, nor enough weakness in the economy, which I think is doing okay, even though it's slowing, to justify an outsized rate reduction. There will be the fear if the Fed does cut by 50 basis points, and people will say, well, what do they know about the economy that we don't know? So I think you should expect them to move exactly as the market is suggesting, and to move by 25 basis points, probably another 2 25 basis point cuts between now and the end of the year. Although, of course, all of this will depend on how the data comes in between now and then.
Absolutely, Mr. Dennis. But thank you so much for joining us. On that note, we will have to let you go. But
if you like this video, then like, share and subscribe to ET Now.